Welcome to this explainer. Today we're unpacking a really phenomenal guide called The Long Game. Look, chances are you've already got the trading apps downloaded right on your phone. You probably know your way around a chart, and you follow the market trends pretty closely. But here's the wild thing. Why is it that despite having literally endless access to super sophisticated information, so many retail investors still end up losing money? They jump into the market totally expecting to build sustainable wealth, but instead they get caught in this relentless, exhausting cycle, basically fighting their own human nature to chase short-term hype. So let's dive into this and fundamentally change how we look at investing.
It's kind of a harsh reality, but we absolutely have to ask, why do most retail investors lose money? Well, the surprising truth here is that failure isn't because of a lack of intelligence. It's not just bad luck, and it's definitely not because the market is just completely rigged against the little guy. The real problem? It's a fundamental flaw in their time horizon. When we should be thinking in decades, we get totally stuck thinking in days and weeks.
To really understand why we do this, we've got to look at our own psychology. Let's say I offer you a choice. Option A, you get 20,000 Naira today, or option B, 40,000 Naira next month. Which one are you going to choose? Honestly, our brains are basically still wired for the hunter-gatherer era. Back then, if you found food, you ate it immediately, right? Because waiting literally meant starvation. Because of that ancient hardwired programming, we're naturally terrible stock market participants by default. We just crave instant gratification. Waiting creates uncertainty, and we want our profits right now. But in financial markets, giving in to that primal urge for a quick win completely destroys our potential for future wealth.
All right, moving on to section 1, the sprinter versus the marathon runner. Let's talk about investor mindsets.
When it comes down to the market, you basically see two totally distinct mindsets. First, meet investor A, the sprinter. This is the person who is constantly chasing fast profits, reacting to every single piece of social media FOMO, and battling extreme fear of missing out. Honestly, it's no wonder they're always so stressed out. They're trying to manually out-trade high-frequency algorithms and institutional bots. It's just utterly exhausting. Now contrast that with investor B, the marathon runner. This investor does their research, buys quality assets, and then they just wait. They embrace this strategic, almost beautifully boring kind of peace. They focus entirely on endurance, staying totally calm and just letting time do the heavy lifting. So what exactly keeps our sprinter friend so frantic? It's market noise. We define market noise as all that flashy information that grabs your attention but provides basically zero real value for long-term decisions. You see, the financial media's entire business model relies on triggering your panic and your greed with these crazy dramatic headlines. I mean, investors panic as billions disappear is obviously going to get way more clicks than market experiences normal volatility, right? It is deliberately designed to hijack your brain's alarm system. You really have to learn how to tune this stuff out.
Which brings us to section 2, navigating the Web3 hype cycle. It's time to separate reality from all that noise.
Let's apply this to a sector where the noise is literally deafening. Web3 and crypto. This space amplifies that short-term emotional trap to an extreme degree. Almost every major project follows these 6 predictable stages. First, it starts with actual innovation, and that's followed by early interest from the developers. But then comes stage 3, the hype. This is when the media and the influencers jump in, which leads directly to stage 4, wild speculation where everyone rushes in trying to make a quick buck. Then, inevitably, stage 5 hits, the painful correction. And look, in the crypto space, we're not just talking about little 10% dips. These are often brutal 80 to 90% drawdowns that completely wash out the speculators. Finally, the dust settles and we reach stage 6, reality. This is where only the genuinely useful projects actually survive.
In this digital arena, you absolutely must learn to separate the illusion from the reality. The illusion is the shiny new project boasting, millions of social media followers and this massive, loud online echo chamber. But the reality? You find that in actual daily active users and real technological utility. You gotta ask, what exact problem is this actually solving? Are real-world businesses using it? You have to look far beyond the daily price chart and the deafening hype if you genuinely want to identify assets that hold lasting, fundamental value.
So how on earth do we escape this totally anxiety-inducing hype cycle? Well, we turn to one of the most elegant, calming solutions in all of finance. Time in the market is more important than timing the market. Look, nobody, not even the sharpest hedge fund managers on Wall Street, can perfectly predict daily market movements. So just stop trying to find the absolute perfect entry point and start focusing on staying in your investments for the long haul.
Let's look at section 3, the power of time and compounding, which is really the true engine of wealth.
If time is the vehicle that gets us to financial freedom, compounding is absolutely the engine. Compounding happens when your investment earnings actually begin generating their own earnings. It's like a giant snowball rolling down a massive hill. But here is exactly why it's so psychologically difficult for us. Those initial rotations of the snowball are agonizingly small. It feels like absolutely nothing is happening. But as it rolls, it gathers more snow, and the bigger it gets, the faster it grows, until it gathers this incredible, unstoppable mass.
And this brings us to a super crucial insight about the math behind your money. Let's say you invest 100,000 naira at a 10% return. After year 1, you have 110,000. But in year 2, you aren't just earning 10% on your original money, you're earning 10% on that 110,000, bringing you to 121,000 naira. Your money is literally multiplying itself. The biggest mistake investors make isn't failing to understand this math, it's interrupting it. The true magic of compounding doesn't happen in years 1 through 5. The truly explosive, life-changing wealth is generated way out in years 15 through 20. When you panic sell during a dip or you jump ship to chase some trendy new token, you're resetting the clock. You stop that snowball right when it was about to gain some serious momentum.
Think about it like this. Would you plant a mango seed in your yard and then dig it up every single day just to check if it's growing? No way. Or consider the bamboo tree. For years after you plant it, there is literally zero visible growth above the ground. Nothing. But beneath the soil, this massive, complex root system is spreading. Then suddenly, out of nowhere, it shoots up rapidly. Compounding works exactly like this. It feels totally invisible and incredibly slow at first, right before sudden massive growth takes over. You just have to be patient and let the roots grow.
All right, Section 4, building a long-term strategy. Let's talk about creating your actual plan.
Let's transform all of this mindset stuff into a beautifully boring but highly effective strategy. And this isn't just a random list of steps, okay? The whole shebang is connected. First, you've got to clearly define your goals. Knowing exactly what you're investing for naturally dictates your time horizon. And once you understand that time horizon, like knowing this specific bucket of money won't be touched for 10 or 20 years, it dramatically changes your relationship with risk. Managing that risk forces you to diversify your assets, so one bad project doesn't completely wipe you out. And finally, you invest consistently. This interconnected strategy totally removes emotion from the equation.
Now, to protect that strategy, you seriously need to go on a strict information diet. You must actively choose to feed your brain with highly useful information, things like actual company earnings, real technological adoption, and broad macroeconomic industry trends. Conversely, you have to ruthlessly cut out the noise. I'm talking about the baseless rumors, the frantic social media hype, and those completely unqualified celebrity opinions. Actively curating exactly what you consume drastically reduces your anxiety. And frankly, it is the ultimate defense against panic selling.
Which leads us to our final section, Section 5, playing the long game and actually achieving financial freedom.
As we bring all of this together, the absolutely crucial point is making the shift from a bad process to a good process. A bad process is obsessing over your daily outcomes. It's chasing shortcuts and feeling like a total failure just because your portfolio dipped on a random Tuesday. A good process, on the other hand, means building consistent, unbreakable habits. Ask yourself, did you invest this month? Did you stick to your diversification rules? A good process provides this profound psychological relief. It lets you sleep soundly at night regardless of what the market did that day, because real success comes from trusting the system, not constantly chasing the outcome.
I want to leave you with this final, really powerful thought to chew on. The market rewards those who stay. Time rewards those who wait. The investor who can delay gratification, who can sit calmly sipping their coffee while everyone else is panicking, is always going to win in the end. So, next time you feel that sudden urge to check your portfolio on a random Tuesday, ask yourself, are you acting like a frantic sprinter, or are you quietly running the marathon? Thanks so much for joining me on this explainer, and I'll catch you on the next one.